Okay, I think we are already live, so everybody that's already listening in, great welcome to a common webinar. I think we will wait a minute for 1 o'clock Dutch time, and in India it is around almost 4 hours later to start. But I'm highly proud that we can do this kind of webinars. We had such a webinar with Germany, with Brazil, and now the very beautiful and very colored uh, and great culture of India, so that we are really going global in our webinars. And today we have a lot of listeners in. I think we have more than 100, so that's great that you with so many people interested in what we can tell you about transfer pricing developments. Yes, and this is one of the webinars we can see also in our Contea Global website, and it will be and is part of our Contea Global Academy. So I think this one, so in Dutch time, so we can start with the transfer pricing developments in India. As said, a combination of Akshay Kenkre and myself. My name is Theo Elsoff. I'm co-founder of Contea Global 8 years ago, and I'm very pleased that I can do this with Akshay Kenkre, who is a chartered accountant and a transfer pricing specialist and the founder of Transfer Price. It's a great strategic alliance from us, and I'm also jealous on Akshay because he writes great books which are very well received in the international community. So that's great to have him, and we did some projects together, and from that project came our idea to get this webinar. And Akshay, may I give you the floor to go into the agenda of today, which I think will bring us a lot from the Indian perspective, and I will try to give some Dutch flavor on this. Okay, Akshay, are you there?
Yes, Theo. Good evening to everybody and good afternoon. Theo, thanks a lot for a very kind introduction, and it's equally an honor here to present before an esteemed audience, and also having worked with you for past 6 years, our network has really grown, and it's fun working with the various offices of Contera Global globally. And I think we did some solid transfer pricing work over past few years, and I hope to continue that in future too.
Yep.
So from today's agenda, we are going to cover some really recent topics, going into a little bit of detail on the management charge, because that's a topic or a hot topic of the current times. The recent dispute resolution mechanisms and some changes there, with the faceless assessment being now adopted by the Indian tax authorities. A quick update on the advanced pricing agreement program, a very important, and again, you can say a very surprising inclusion of transfer pricing in the startups and the new manufacturing company tax, and some of the essential components of transfer pricing in the COVID situation. So with this background, I would take it forward. Next slide, please. Thank you. So from the Indian transfer pricing law, it has just crossed its teenage and has entered its 20s. It was implemented in 2001, and we are now in 2020. So in these 20 years, India has emerged as a mature jurisdiction in the field of transfer pricing, with a very strong voice on transfer pricing at various international forums. While India opened up its business to the world in 1991, it saw that there are instances of tax avoidances coming into play where investments are flowing in terms of capital. However, such investments are taken back to the investment destinations by undertaking fancy transfer pricing models, resulting ultimately into base erosion and profit shifting. This phenomena continued for almost a period of 10 years. And as a result, transfer pricing law was born in 2001 in India. As it happens in general, with various other new aspects of life also, it took some time for the Indian corporations and the professionals, including the tax authorities in India, to decode the legislation. However, since the beginning of new tax assessment from say 2006, a lot of judicial clarity and interpretations were brought out by various tax courts and tribunals, thereby leading to a very strong legislative and judicial foundation for transfer pricing in India. As the time passed by, year 2012 was the peak for transfer pricing adjustments, where tax authorities had gathered a lot of meat on the tax avoidances and were addressing it by taking aggressive positions in the transfer pricing arena. This was the same time when the entire world was up in arms against the global multinational avoidances, which ultimately gave birth to the BEPS project of OECD in 2013. The problem of tax avoidance was same globally. However, when India tried to address the issue, it was tagged as being a tax aggressive country. Other countries took more of a participative approach with hopes on BEPS project to solve the tax avoidance issues, in which even India was one of the forerunners. The focus of transfer pricing now has moved from simple transactions like ITS and other benchmarkings to a more complex and a thorough regime with issues circling around things like, say, management charges, the IPs, the location savings of the world, the royalty charges, interest, say, corporate guarantees, share transfers, etc. In the last 5 to 6 years, transfer pricing in India have attained a level of proficiency where the level of litigation has come down. Taxpayers are given a greater responsibility of self-administration and undertaking compliances with transparency where the tax administration has higher visibility for governance. India has been a forerunner in the BEPS project and have adopted almost the majority of the BEPS project plans, if not all, whichever seemed, say, practical and applicable to the economy at that point of time. Now let's turn towards certain specific issues that we intend to cover today. The first one of that is the management charge. Now let's first understand about the management. A company in general has, say, two sets of management. One is the strategic management and the other is operational management. Strategic management is generally taken care by the board, and the operational powers are then decentralized with the management of the company, who could be the CEOs, the CFOs, the CEOs, who are also a part of board, but they are more into the day-to-day operations. Similarly, in a multinational outfit, at a group level, the operational powers for overseeing the group are vested with, say, either the regional or the global CEOs and the CFOs. Management charge assume a very important position in the transfer pricing studies, as this route has been one of the three most famous routes for shifting profits from one jurisdiction to another. The other two routes, for the sake of our interest, is actually interest and royalties. The specialty about these routes is that the nature of the payment that it is made. All the payments which are made towards are something very much intangible, something that cannot be seen or felt. Let's take an example and I will explain you about all the three types of payments which are made. Say management charges is paid towards a service which is intangible in nature. Interest payment is towards the time value of money and the risk undertaken, while the royalties is towards the use of certain intellectual properties. Such underlying base assets and service provisions are very hard to track and document. The basic nature of the management fees or charge makes it a high potential transaction that is capable of shifting or managing profits in the country of source. Where the service is directly provided only by one entity, the complexity matrix for such a service is low, and one may be able to find a comparable transaction or profitability factors in transfer pricing studies. However, when the service provisions are scattered across various countries and further allocated to the countries based on certain allocation ratios, this raises eyebrows of the tax authorities of the country which is paying such service charges for. We can call such scattered service which are more complex in nature as common services, and these are the services which will form a part of today's discussion. We have seen numerous litigations and judgments around the matter in India. The matter is yet very far from a principled resolution, as every management charge comes out with its unique set of facts that could be different than the previous. The attempt today would be to decode the nuances of management charge and seek certain plausible ideas for your implementation in this area. Now, there could be two broad scenarios which are stated on this site, on this slide. One, where the global or regional management hub is outside India and is overseeing the Indian operations, which we can say term it as inbound management charge, which India would be paying, while the other could be an Indian management overlooking its global operations from India, which could be termed as outbound management charge. Both the issues from a transfer pricing point of view have different viewing angles when it comes to the issues and the base that it needs to solve in terms of a transfer pricing. Let us first look at a case. We can go to the next slide. Yeah, we can look at this case where there is an Indian subsidiary and the global management is providing services to India. Let's go to the next slide. From a transfer pricing point of view, there are two main questions to be answered in this case. Now, this is almost very close to the OECD guidance which is given. And although there is no strict guidance on this from an India point of view, most of the judicial precedents have tried to interpret the OECD guidelines, and accordingly, we are expected to maintain transfer pricing documentation. Let's look at the question number one. The first question here to answer is whether the services are indeed being received by the receiving entity. And the question number two that needs to be answered in a transfer pricing documentation is whether such services are at an arm's length price. Now, many a times you only answer question number two by doing the benchmarking analysis, but often forget the question number one, which is actually the moot point of most of the litigations around the Indian jurisprudence. The answer to the first question is often given by undertaking a benefit test. Such a benefit test needs to be evaluated in three parameters, which are mentioned here. That is the need for the service, the actual receipt of the service, and the ultimate benefit that it has provided to the entity in India. The burden to prove such a substance in the activity completely lies with the taxpayer, and so is the burden of proof of maintaining the documentation. And a taxpayer is expected to maintain all necessary documentations to prove the genuineness of transactions. The first question that the tax authorities ask and is expected to be addressed in the transfer pricing documentation is the need for availing such a service. It is expected that the taxpayer provides detailed reasons for the need of such services. This might get complicated and may sound similar to providing a reason for visiting a restaurant, actually, despite the fact that food could be made at home. Although the reason for visiting a restaurant could be as easy to comprehend to say, okay, I have visited a restaurant just for a change. When it comes to transfer pricing, the tax authorities may not like to proceed with further understanding of the transaction until such reason is justified for.
Okay. May I have a question here, Akshay? Because I think
Yes.
this is an important part of our discussion. If in the Netherlands we had discussion on management charge in the 90s, and show me the benefit was something that was present at that time, and that led to more consensus that a multinational and has such kind of activities. And if you put the shareholder activities apart and you take account from it, then the benefit test is something that's difficult. It's more that we more look from an European side if the activities are performed, not performed as a shareholder, and
Right.
then things as the need or the benefit is less important than that you have a real good structure in place and that it is audited, that you can as a tax authorities look at it and say it seems to be in something that has a structure and can be audited by tax authorities. So there is some, and that I feel sometimes when I have a discussion, the benefit and the benefit test is difficult. We see it more that the activity is provided for and the costs are made. But if we have a discussion together, then there should be for India, but a lot of more countries, there more stress on that there is really a benefit. Can you give maybe some examples of it, how to do it? Because that seems to be more the underlying discussion each time.
Right. So that's exactly the point. It's more about proving the receipt of those services and what type of benefit or a tangible benefit it has had to the ultimate subsidiary company. First of all, those should not be the shareholder activities. However, if we need to look at an example, let's take an example of a CFO service. Okay, the service would say include a service by a CFO as well as the CFO's office. And the evidences around this, because the CFO service is an extremely intangible service. A CFO could be taking strategic decisions, or he might be just giving out a single email which could have a value of millions of rupees attached to it. But it's not the time that he's investing in writing that email, but the value that that email is carrying. And that's why some of the examples of benefit test could be certain compilation of mails, say from a global CFO's office, and also counters from the Indian company, certain compilation of advices, certain MISs shared from an Indian perspective, certain analysis performed on those MISs, certain external consultant certificate, say stating the actual verification of such existence of CFO's office per se there in at the head office, and it's just not any fake employee being recruited as a CFO, and certain evidence of third-party payments or backup documents. Now, it's very important that all these documents, although this does not have a direct relevance to benchmarking, it is essential that these documents form a part of the benefit test that a taxpayer needs to showcase. So whenever a CFO, say, is sending an email from a head office to the Indian subsidiary, if there is an email address which is copied, say management charge @ so-and-so.com, and then there is a repository of such advices that the CFO's office is already providing and that is certified by an external advisor, that would really help when you are representing the case at the tax office level.
Yeah, and I think maybe from my experience, it's not that you do it with everything that is done, but that you have a really clear examples, so that you have a first step of documentation that there is some benefit attached to it for the company receiving the invoices.
Right. Right.
Okay.
Right.
I
And it's
understand.
also important. Yeah, sorry, please.
Go on. Sorry, Akshay.
And it's also important that their cost and benefit is ultimately matched. So we cannot be spending, or a multinational cannot be spending millions of dollars in maintaining the documentation, which is amounting to peanuts. So that should not happen. It has to be the compliance, the right set of compliance at the right cost. That's extremely important. Otherwise, it might go overboard.
Yep.
Yeah. In fact, in many Indian judicial precedents, the courts have stated that the tax authority shall not question the business wisdom or commercial rationale of the management charge. However, that is only possible when some level of documentation is maintained. So It cannot happen that without a documentation, you tell a tax authority that you cannot challenge anything that we are doing. So let's move on to the third aspect, which is what Theo also mentioned. These are the tangible benefits. And this could be really tricky, and the tax authorities could argue that even if the services are indeed needed and received, such services could be treated as a non-chargeable activity. In such a case, it is imperative to prove that an independent third party would be ready to pay for such services. Further, one needs to prove that such services are not shareholder activities, duplicate activities, or incidental activities. Now, let's take an example. I mean, just to elaborate on the shareholder activities. Shareholder activities are activities that are performed only out of the ownership interest. Such an activity is undertaken by the shareholder on his own account to protect its interest, and hence the benefit does not percolate down to the level of subsidiary. Right? And similarly, when we talk about the duplicate activities are such activities which are duplicated for the benefit of shareholder itself. That could include, say, a parallel accounting or certain different type of reporting in a different language. And these are all duplicate activities. However, a second opinion taken by the parent company cannot be directly regarded as a duplicate activity in this case.
Okay.
Right. Now, let's move towards the second part of management fee, that is the valuation of services to be at arm's length price. Yeah.
Yeah.
For less complex services, which are specific services, a direct method is used for charging, and hence this method has less arguments in building upon. The challenge comes upon when the method becomes indirect and the group is aiming to charge common expenditure across. In such a times, the allocation ratios are often seen and challenged by the tax authorities. It is important that any allocation ratios implemented are scientific and based on a rationale that is well explainable. I would personally suggest developing a transfer pricing policy and a price setting mechanism around management charge, which could be made available to the tax authorities in such time of needs or confusion. My other suggestion would also be to get the allocation ratios and the cost data audited and certified by a transfer pricing advisor at that point of time. Many a times the case goes into litigation due to a lot of unclear and non-maintenance of documentation, even around this aspect of allocation. There has been seldom a litigation around the percentage markup in general. It's more about the matters that we earlier discussed. The litigation moves around that because generally a 5 to 6% markup is acceptable and is generally considered acceptable by the Indian tax authorities.
Yeah, for the inbound. Yeah.
For the inbound, yes, we are just on the inbound, not on the outbound. So
Okay.
sure.
Because
Yeah.
what I see more in my discussions is less on the benefit in Europe, but more on the structure and as I said before in the beginning of this slide, more on that it can be audited after the fact, that you can't influence during the year. That is very objective and clear how you do it, and
Right.
And sometimes. It helps when you even have an auditor saying something about the system that is all in accordance with the policy, and that could also be a transfer pricing specialist. That helps when you have a discussion with the tax authorities, because they feel that you after the fact can influence it, and they don't like that kind of subjective way of working. And if you can be very objective in this and can really share the audit trail and have a third party saying something about it, then that helps a lot. And these kind of discussions. That's my experience.
Yeah, absolutely.
Yeah,
Absolutely. Yeah. So we may just move on to the next slide, which is just connecting my points on the 5% markup.
Yep.
Yeah, and that is on the low value added intragroup services driven by the BEPS project. This aspect was mainly borrowed from BEPS. The manner of adoption and the definition have been kept inconsistent with the BEPS project. The concept mentions that the taxpayer could take a charge of certain low value added intragroup services at an assumed markup of 5% without maintaining any additional documentation around the markup of 5%. Low value added intragroup services does not mean irrelevant services, but services that do not have a direct relation to the core of the business. When this concept was out somewhere in 2016, we had certain industry friends and colleagues discussing with me, stating that now accounting services are one of the listed low value added services. And ideally, accounting is a very important and specialized work. Then how it could be a low value added services? One needs to understand that for an accounting firm, an accounting service may not be a low value added service. However, for a manufacturing concern, accounting is one of the support services, and this service does not add a directly correlated value to the output of manufacturing. From an Indian safe harbor point of view, this concept has been subsumed in safe harbor. The above discussed steps are important, and it expects an Indian chartered accountant or a large multinational global accounting practice firm to audit and certify the cost base and allocation ratios. It is only the markup of 5% which has a leeway for non-maintenance of detailed documentation. One very important point to remember here is the right categorization of the services provided by the foreign arm of the multinational company as a low value added services. Such services shall be more supportive in nature. These are all BEPS oriented points. A non-core service, which are provided without any reliance on intangibles and does not involve, say, a substantial risk by the service provider from an Indian perspective.
Question here, Akshay. I see that a lot of discussion I have with head of tax that try to use the 5% for more. And if you look at the OECD guidelines, then things like key management, like the board of key managers, of lead of maybe sales or R&D, also under the 5%, but that is normally not in accordance with the guidance in that field. So that the right characterization and justification, I think, is very important, because even you could have a discussion not only if it is a cost-based, but even maybe a value-based activity. Yeah? So look out with using the low value add safe harbor. That's not an answer to all your topics, I think.
Yeah. No, it's just not given that, say, accounting service or R&D is a low value added service. It should match the realities and the facts of the case.
Yep. Okay.
Let's go to the next slide, which is mainly on the outbound services. Now we are just flipping the tables. This is the Indian management providing service to a Dutch subsidiary.
May I have a question here?
Yes.
We have that India is a forerunner in the OECD, and then you get some questions about sometimes the high markups from service providers from India to as an example to the Netherlands. How can you bridge that both? Because international accepted percentage of markups are mostly between say 3, 4, 5 till 8, 9%. If you go up to 10 or more, then it becomes more questionable if it is a cost-based activity, because if you go up, it seems more value-based. And when you go to India, then you always get the discussions about a separate markup or discussion. How do you manage that bridge? Maybe a question, a couple of sentences too early for your answer, but would like to get your answer on that question.
Right. So it's a very important question. I think from a transfer pricing world perspective, it is important to understand there are two types of economies. There could be multiple, but at least for this discussion, there could be two types of economies. One are the stable economies, where the margins that an enterprise makes varies between say 3 to 7%, and that's why 5% is something which is more settled markup. Now let's look at an emerging economy like India. Here there are multiple opportunities to do business. There is a lot of competitiveness, and companies are making, which are comparable, higher markups or margins. So ultimately you are getting comparables which are having those higher margins and markups. and that's why we cannot adopt that 5% when the comparable companies itself are giving, say, around 15% or 13 or 17% type of markup in and around. Secondly, when we are talking of a specific model of, say, a cost plus, it's also important on what that cost, on what that markup is computed for. If your cost base is going to be extremely heavy, then in absolute terms, your 5% markup on that heavy cost could be equivalent to a 15% markup on a normalized or a lower cost. So that's also something that we need to see when we are looking and thinking about a source-based taxation point of view. So it's just a balance between a stable economy and the emerging economy that the global transfer pricing should understand.
And to be honest, I think the first comment I understand very well. The second, there is some theory behind it. If the cost base says something and low value cost base says something about the markup, but that's maybe for an interesting discussion for 1 hour for separately. But it is more the emerging market, which you say that gives India a position to if you look then into comparable situations, that you see that the higher markup derives from that, let's say, market comparison in India. So,
yeah.
And then you come to the next step, and then it should be arm's length. Okay.
That's
okay.
Correct.
That's okay. Just saying, because I see often that the markup is applied consistently around the globe almost, and for India and some other countries it goes up. But okay, maybe an interesting topic to write something about sometimes, because it is often coming up as an item.
Yeah.
Okay.
Okay. We can go to the next slide, which speaks more about the outbound management charge and fee. Okay, great. Thank you. Okay, place of effective management is one of the recognized tests for determination of residence of the company, incorporated in the foreign jurisdictions. We popularly call this as a POEM or POEM. India earlier had a concept of control and management, where the foreign company would be considered as a resident in India if the whole control and management of the foreign company is based in India. This led to certain ambiguous interpretations and increase in litigations. Therefore, there was a need felt to bring in the concept that various international tax treaties already carried, which is POEM. POEM is an anti-abuse provisions introduced in financial year 16-17 to primarily cover foreign companies which escape the residential status in India by shifting insignificant or isolated control and management outside India. The location of the multinational head office is an important factor in the POEM analysis, as this is the place where the senior management personnel of the group are located. Generally, multinationals take a view that such activities are considered as shareholder activities and do not charge the same to the subsidiary companies. Now this is from India to outbound. This is not the inbound way. The TPOs might take a view that while providing such services from the home country, the POEM of such foreign country may be seen in India, thereby attracting the profits of foreign company towards the Indian tax attribution by using a profit split method. Such positions have been taken in few cases, although these cases have not gone beyond the tribunal level, but these positions have been taken, and that's how the documentation that you maintain becomes extremely important. Further, the allowability of such expenditure as a shareholder activity also needs to be seen from a general expense deductibility point of view, as expenditure was not specifically incurred for the purpose of Indian operations, but for the purpose of monitoring foreign operations. Structuring an outbound management charge could be seen as a double-edged sword, which needs to be used and crafted very diligently and carefully as per my view. I would suggest a very robust and meaningful documentation on transfer pricing for inbound as well as outbound management charge.
Yeah, maybe a question here. So I see a lot of the discussion came up in my practice on an R&D. Yeah? If it's something is as a service as contract R&D, or it is more, is that also something that in India comes up, because there's a lot of innovation and R&D services from India going across the globe.
Right. Right, but that's where we are looking at inbound. This case specifically comes up from an outbound perspective, where the head and the management is sitting in India and serving the foreign company.
Yeah,
Yeah. So it's a
and
structure that we need to see first.
okay, I understand that, but I think that's the question that came up from our viewers, and therefore I put it on the table now. But okay,
Okay,
yeah,
great. Okay, there are
okay,
some good questions coming in. I guess surely we will address few of
okay.
those.
Let's see if we can put the questions during the course of this 1 hour, or that we take it offline. But this was a question that came up on the R&D, but that's indeed inbound. But let's go further and then see where we can take maybe at the end of the sessions those kinds of questions. Yeah.
Yeah, I think we will have around 10 minutes for that.
Okay.
Great. So quickly we can go on to the next slide, please. Talking about the dispute resolutions, the very important topic on tax charter. So 13th August 2020, which is a very recent development, our Honorable Prime Minister Sri Narendra Modi unveiled the tax charter for the Income Tax Department. For the first time in the Indian tax enactment, the tax charter lays down 14 commitments from the perspective of Income Tax Department and also inks certain expectations from the taxpayers to meet the goal of both the parties. The charter is expected to lay down a roadmap towards how a taxpayer's case is handled by the tax officers in general. This is a major step in the direction of increasing the transparency of the tax administration and increasing the confidence of the taxpayer. Adopting such a charter in the income tax law holds that the commitment made by the income tax are enacted in the law, and any faltering of these commitments could have legal backing and consequences. The behavioral science of the way how a case is processed now would have to walk within the four corners of the taxpayer's charter. It's a very important development. Of course, I will not repeat the commitments and the expectations here. The charter is really aiming towards a transparent tax system. I would say reloaded with a lot of tax reforms aiming to create a friendly and service-oriented tax environment in the country.
Okay.
Yeah.
That comes a little bit to what happens in the Netherlands. We, in around 2003 and 4, we had a start of what we call horizontal monitoring, as a sort of self-assessment, which was seen as something as a solution for audits for past 5 or 10 years, but which happened with a lot of problems, to coming to a position that you are talking to each other, that the company explains their risks and their questions, and hopefully as most recent as possible, and not 10 years ago, but maybe last year or the coming year, and being fair to each other. That happened, and it was, I think, 2004 till recently development in the Netherlands, and that's I think still there as a basic attitude. But what we're seeing lately is that there is far more again audits going on.
Sure.
Because there's a balance. It is like time, and you get a certain development, and then on the top, and then you get a counter reaction, and that's what happened in the Netherlands. And it seems that what you're having here is that start of talking to each other and exchanging questions and answers. Is
Right.
that the case? Yeah.
Yeah. So good to know. Good to know the Dutch perspective also here. I hope this brings in a lot of coordination and transparency between the taxpayers and the tax authorities.
Yeah, that's what then happens, and in a small country like the Netherlands, that is also highly important because you are in the midst of the international trade, and it gives a lot of transparency and professionalism to each other, and also the possibility to discuss and to agree on items.
Right.
But what you see, if that's a long time going on, that you can have also counter reactions, and and that's somewhere happening in the Netherlands. So that's to say, the basic assumption is still what I'm reading here: honesty, fair treatment, confidentiality, etc. That's still the case, but this really to see how this development is going the coming years. So I'm very interesting how it will develop. Also, because if you go to your next slide, you see that there is also a lot of analysis used and IT used to get the right multinationals to the table.
Right. So next slide is also a development which is very recent. This has become the talk of the town, and I feel for faceless assessments, technology could be the greatest enabler in undertaking the risk-based audits. So technology could be used to zero down on the problem area while simultaneously reducing the litigation burden on the economy. Minimum government and maximum governance could be achieved by using technology as an effective tool in the tax audits, and faceless assessment concept is in the right direction for this. Currently, most of the assessments are computer driven, although even today. However, there is still a manual intervention when it comes to, say, selection of cases as well as assignment of cases. In faceless assessment system, there would be no intervention or discretion of the tax authorities in the selection of assessment cases. Further, all the notices would be issued centrally through the National E-Assessment Centers, we call it NEAC, in electronic mode only. The assessment would be a team-based assessment where the order is issued, say, in one city, it could be reviewed in some different city, and the finalization is done in a completely third city. This brings down the power and the discretion that a single tax officer carried to subjectively interpret a technical area. Along with the national e-assessment centers, there would be a network of regional e-assessment centers too, who would work on similar cases. The centers would comprise of units like, say, a verification unit, a technical units which will make technical positions, assessment units which will be actually on audits. So we call it assessments, in Europe they call it audits, and certain review units which will be reviewing the audits which are undertaken. From a transfer pricing point of view, so what it means from a TP point of view, faceless assessments could be a boon as well as a bane. Boon because of the obvious benefit that it carries. However, a taxpayer should be aware that transfer pricing is more about business and explaining the business to the tax authorities. The businesses are not very easy to comprehend with multiple complex transactions undertaken by the companies on daily basis. Anything which is written and read does not carry the same emotions or similar messages that could be intended to the reader. This means a lot of stress needs to be given on the documentation and the submission that needs to be made. Now you could see from certain WhatsApp messages that you write, the receiver of the message may not take in the spirit of what you are actually writing. So there is a lot of this WhatsApp era that we are generating, which places a lot of importance on the written communication, and emotion is never carried to the other side, and that's where the issue is, because TP, the business emotions, the business rationale needs to be conveyed. Mm-hmm. I have personally seen hundreds of papers being submitted to the tax authorities with a possible aim of confusing the tax authorities if they are not able to convince them. A similar approach could now act against the interest of taxpayers, with lengthy and irrelevant documentation being submitted to the tax authorities. The level of documentation now from a TP point of view needs to be top class and easy to comprehend even by a layman. So you can't go all technical gaga about everything. It's keeping the things very relevant, because the person who is going to read it, he is going to read a relevant thing. So a 350-pager transfer pricing documentation for a small transaction is not going to yield any results. So I always say keep things extremely relevant from a TP point of view.
May I say something about that? I think
absolutely.
I think if you look into this kind of items, then often I say the technicalities are maybe 10 or 20% of the story, but 80% is process management, and having your storyboard ready and your financial in accordance with the story. And that should also be in everything you write on documentation, looking at your CBCR, but what was also happening now on mandatory disclosure and DAC 6, it should be one line that supports and helps you. And you need it, because like in the Netherlands, we have and that's remarkable, we have the same thing. On the one side, the horizontal monitoring, that's trying to be listening to each other. On the other side, the use of tools, IT, and audit selection. And the problem is when that comes together, that they got so much information and items that in the end, to get a real good discussion with each other, that's the key, because like in the Netherlands, there's always a problem on having professional, experienced people on the table that you can really have a good discussion. And that in the end, is maybe the problem to get the key people. But I think, and for this, to have that really good process, you need to have your story together in all what you're writing. And don't, sometimes I see more an analyst report of a lot of paper, and then you have to look for the story in it, and then and then you have a problem. So I think a lot of people had, after the BEPS, trying to be compliant with thick pieces of paper to get documentation ready, but we are now going into an area and a time that you need to have your story together and you act together in all the items that you are presenting, and that's also what you're explaining, I think, a lot. So I think we are there, like India, but Netherlands and Europe, around the same way of looking into what to do and how to deal with your compliance burden.
Yeah,
it's not only paper.
Yeah.
Okay. And
I think it's a smart work than hard work. It's how smartly you can explain a position rather than doing all the hard work of maintaining bulky documentation.
That's true, and I have a lot of experience also in maps and APAs, but also in mutual agreement procedures between the countries. And mostly the problem is not the amount of paper, but that nobody understands really the company, the business, the storyboard, but also the relevant facts and circumstances are more scattered around the place.
Right.
So you have, and that's really important. Okay.
Right. Okay. Let's go to the next slide. Yeah, APAs. So talking about APAs, APA now is in the 8th annual cycle, and this is the Advanced Pricing Agreement Program, and it has been a great success in India over the past 8 years. In the APA, the taxpayer has an option to approach the APA authorities to seek clarity on the transfer pricing aspects for the company for the next 5 years, and an option also to go back for the past 4 years, overall totaling into a tax clarity of 9 years. Similar to transfer pricing law, India has been a late entrant in the APA program. Countries like Canada, US, Japan, or UK have well-established APA regimes since past 30 years. In the last 8 years, more than 1,200 taxpayers have applied for APA program, out of which 80% are unilateral and the remaining 20% are bilateral, which is discussions between two competent authorities of two countries. Recently, the bilateral APAs have gained popularity from an Indian point of view, as the Indian competent authorities were able to successfully close and resolve APAs with several countries like the US, Japan, UK, Netherlands, also Switzerland, and more taxpayers are now opting to convert their unilateral APAs to bilateral APAs. Is that emotion and feeling the same at the Dutch level also from an Indian APA point of view? Theo, do you have any pointers there?
Pointers from India or for the Netherlands? Because
from the Indian transactions, for the as how the Dutch authorities are perceiving when it comes to bilateral APAs with the Indian authorities. Is it very smooth? Is it very is it this cost plus 5 and cost plus 15% argument that you generally get into?
I think that's developing. That's maybe the right word, because I've been with the tax authorities 2001, 2007, and also heading the APA team in the last years, and also did a lot of maps and bilateral APAs around the globe. And I didn't have the privilege at that time to with India, but with other countries. But it's like everything, and you need to have the time to talk to each other, and then after 1 or 2 years, then a process will go along, because there has to be some trust in each other, like it's always with people. And you see the same thing with the Netherlands and India. They both have the same common professionalism. I think that's the first step, that there are professionals knowing the business, and that happened, and that led to a very good cooperation, I think, between the Netherlands and India, because both try to make the APA as a process work, and I think that's important. And there, I think, at the moment we see more and more APAs between the countries discussing, and that is great. And maybe something on the APAs itself. The Netherlands had a very long history of rulings, and then since 2001 the APAs, because that's something which came along with the OECD work on APAs, and we had since 2001 an APA OECD compliant practice. And I think that the numbers you mentioned were around the numbers I already had when I was head of the APAs. So the Netherlands is very professionalism in this field. Although I have to say that because we were so successful on APAs, there is some more formalities brought into the process in 2019, which gave for a short period a moment of what's happening. But that's, I think, within a year now, going very well for the Dutch APA practice, and we have a lot of discussions with them on how to make the APA practice more successful. And in that light, you can see that there were a lot of unilateral APAs, but because of those attention of the APA process, we see that bilateral and multilateral APAs are more and more in the picture, also for the Netherlands. So, and therefore, I think there's a good basis for having the items that from the Netherlands to India, or from India to the Netherlands, would be something to think about an APA process, because that gives you a lot of, I think, certainty, and it is an important part of your strategic risk management. I see APAs as a strategic risk management tool. And that could. Okay.
Great. So some quick statistics from the government's annual report on the 300 APAs which have been signed till date. It states that on these 300, it is bringing around 1800 years of tax certainty, because if you say 5 years plus and backwards 4 years, that becomes 1800 years of tax certainty. Now let's assume that 50% of such complex issues would have reached the litigation level. APAs till today in last 8 years have declogged the court's time, which is the tax court's time, by 900 cases until now. So that's a big achievement when we convert that into the statistical form. The only hindrance there is the time taken by the APA, which the APA authorities are working on. That is around 30 to 35 months. But now, after following the MLIs, we would like to get that time below 24 months, which is a strong commitment even from a government's point of view. Yeah. So that's a wish, and that's where the government is also working towards.
I may say something as last. What the APA is more seen as to get certainty for the future, but like you in India, you can also roll back for 4 years. I sometimes use it to get a solution for a possible audit, because it is more often seen as certainty going for the future, but you can also see it as a tool which gives also certainty for the past. That's,
Absolutely.
And therefore 4 years rollback is a long time. I did personally the first rollback in the Netherlands 15 years ago. With 4 years, that's a long time. Do you know why it is 4 years? Because of that That seems a lot, huh? Yeah.
So ideally, I say there is no rationale for 4 years, but the logic that I could derive out of it is by the time your case reaches the assessment stage, which is the audit stage, it's around 2 to 3 years. And by the time you understand the output of those cases, that is 4 years. So if you think that there is an injustice which is happening at that point of time, you can apply for an APA and go back 4 years to give effect of that APA even to the last 4 years. So that could be the possible logic built in. But all I could see is that 9 wide years of a good certainty for a tax strategy and a transfer pricing model point of view.
So India really understands that you can have an APA as a solving for solving long time audits. That's what I'm reading here.
Right.
That's great.
Absolutely.
I think it's not possible in a lot of countries. They only see it as something for the future, but this is really an item you can use in your risk management. Oh, great.
Absolutely.
Okay.
Yeah.
Yeah.
Yeah, let's go to the next slide. A quick outlook on the top transactions, which are year-wise. I won't go into much of a detail here, but if you see for 2016, 17, and 17, 18, your transactions which are there, which got concluded for various unilateral APAs are almost consistent. India is an IT hub, so but obviously there will be software development companies, ITS companies. But when we look at 2018-19, which is the most recent years, you do not find ITES and software development there. You find more complex solutions and agreements being entered into, which are like a royalty, license fee, technical support services. Now it's very difficult to arrive at an agreement for things like this. So it means that India is growing and maturing in terms of the quality of the APAs. We should not only look at the quantity of APAs, but also the quality and the nature of the qualitative agreements which it is entering with the taxpayers throughout. So I just wanted to bring this out to you as just an instance right now. So let's move on to the next topic, and that's the tax holiday and transfer pricing. The tax deductions and exemptions in India has its own flavors. They are very carefully crafted and have been tested by the global tax forums for not promoting tax avoidances. Two of such tax holidays, there are others also, but the recent ones are one for the eligible startups and other for the new manufacturing companies. The eligible startups are given a benefit of zero rate of taxation for any consecutive 3 out of 10 years of its operations. And for the new manufacturing companies which have been established post October 2019, the rate of taxation for such companies would be a preferential rate of 15%. This is mainly in line with the boost in manufacturing sector that the government is aiming at, and also in line with the vision of Make in India initiative of the government. As these are two new tax holidays, do have certain tax advantages over the other kinds of taxpayers. There could be a tax avoidance opportunity that could be explored by the domestic groups to shift higher profits to such startups or new manufacturing entities. To avoid such situations, domestic transfer pricing was made applicable to the cases where such tax benefits are claimed by the eligible taxpayers. When a close connection, that's how they define it, or an associated enterprise transacts with such eligible startups or manufacturing companies, that transaction needs to be undertaken at an arm's length price. Considering the definition of close connection, it is really not defined in the Act anywhere. The same could mean a connection even without the other enterprise being an associated enterprise. The term close connection may have a wider notation than associated enterprises. Therefore, for the transaction of certain eligible startups and also new manufacturing companies may need a closer look at the nature and the connection behind such transactions, what it is entering into. I would say best to evaluate and obtain a general opinion or certificate of non-applicability of transfer pricing or applicability of transfer pricing in case of such tax holidays and get the desktop review done. Now, that's more domestic transfer pricing for you here, and many of you might be interested in this. More than happy to answer any questions going further on this. But let's come to something which is of a great relevance as of today, and that is transfer pricing and COVID.
Yeah.
Of course, I think this is something that you have, Theo, tackled in your past presentation also for QG Academy, but I just wanted to give more of an India flavor here, because this is the first time in history that today's working generation is facing such a global pandemic. This is the first time occurrence for all of us, and same is the case with the global principle of transfer pricing. Transfer pricing at a global level has never seen such a disruption in the global value chain all at once. Transfer pricing speaks about the pricing of goods and services, and the fairness of such pricing is determined to the profitability made by respective entities in the value chain. With the shrinking of value chain, the entire profit chain, including the Indian profit base, would reduce, and therefore there would be a direct impact on the tax treasury of all the countries, including India. In the past 6 months, many industries have been affected, and we have spoken to many promoters and industry colleagues on their transfer pricing issues and their business modelings. There has been new business models that were built around the technology and technology aided business, and many transfer pricing models have been engineered for. A simple example could be the captive units, including the ITS and IT development industry. A simple transfer pricing model of a cost plus percentage was put in place by many. However, due to the cash flow pressures, I would say the conventional industries were not able to maintain the type of percentages that were retained by the entities earlier. One may need to think what type of margins or markups to retain now, especially when the industry could be showcasing thin margins. However, from a review point of view, such a visibility on margins in the industry would be available in public domain only post finalization of financial year 2021, because today we'll not be able to give any outlook on the markups that the industry would make in this year, because this year is the year which is getting impacted. But the decisions have to be taken today. Another aspect to evaluate are the intercorporate agreements that are entered by the taxpayer with their AEs. Due to changes in the business circumstances, they might need a relook from a transaction perspective. In case there are any renegotiations that are needed to build in, this is a good opportunity. COVID will surely impact the comparability analysis. Global master files would be a relevant document to showcase the impact of COVID for the entire group at a group level. In addition to master file, even the industry overview, which is often considered as an irrelevant part of the transfer pricing documentation, may need a fresh look. There has been instances and habits to carry forward industry overview year on year. If such overviews are also carried forward in the year of pandemic, the report might give a contradictory industry story to tax authorities, which may give rise to conflicts in future. And just multiply this by the e-assessment that we are talking about. An extremely important aspect now is the thought around multiple year data. Multiple year data for comparability in general used to do away with the abnormalities in the business cycles, so that the average could be attained to facilitate comparison. Year 2020 would be a year where most of the businesses would like them to be compared with the medians and the averages of the specific year than the averages of past. Therefore, one needs to evaluate whether there is a possibility to undertake a limited one-time analysis or consider certain beta factors or variances, which are more statistical in nature, which could act as an adjusting factor to enable comparability. Now, another point of, yes, Theo?
No, please go on. I think just say for we would like to say we had that webinar on it, and that's on our website. But I think it's important what you're saying, and the reason is that COVID alone is not sufficient proof that your arm's length results should go down. So the markups and the percentage on sales and T&M should go down. I think that's not sufficient. You have to, and therefore I'm really liking your comparability analysis. You have to go to all the comparability analysis to really document what your position is that you're going to take now. and that's difficult. The other thing is, and I had the privilege to get the first recession in around 2008, 2012, and the problem there was that the benchmarks coming out of that period shows even higher markups. So so it is not that in the TMM, in the searches on the databases, you'll find your solution. It was remarkable that after the recession time, we even had higher markups and percentages. And I think that comes because only the really good companies survive such a recession, and therefore you got even better results in your database search than before. So it is really important it is important to go in your analysis. So like the industry analysis, what's happening in the market, and that you get more market related items into your documentation.
Right. And we can just extend that to the next point. That's a very relevant one, is the receivables, where there could be certain outstanding receivables which are not received in a certain time period because of the working capital pressure. So it's very important to make any type of changes around the receivables policy that the global multinationals have to adjust it for. Otherwise, there could be indications of deemed loans given by, say, Indian company to a Dutch company in the scenario where Indian company has certain higher receivables to be received from a Dutch company. And of course, the last point on this are the COVID related charges and their acceptability in the Indian Income Tax Act. This is not so much unsurprising, but because the companies have incurred certain specific COVID related charges, and that is not specifically given as an allowable expenditure in the Indian Income Tax Act, whether such charges could be subsumed as general expenditures and deductions is something we need to see and evaluate under Section 37 of the Indian Income Tax Act itself. And the point on APA, Theo, this is very important. There is a provision of revision for APA. So if you have recently got into an APA and you have another 3-4 years to go, I think it's very important that you could file for a revision of those APAs so that the critical assumptions and the factors could be changed and adapted for the current levels of the pandemic that we are seeing right now. It's always good to go back to them.
Yeah, true. And to be honest, we had a similar experience in 2014 and 15, and even before, because that also impacted the APA. So it's good to have that discussion somewhere. It is, I think, for time's sake, too much to go into, but I think this is extremely important, and that you look into the APAs also in the Netherlands, because that could be too much, the percentage that you agreed upon. Okay.
Right. I think with this, I would like to. Would you like to just take the conclusion slide, Theo, on this? Over to you.
Yeah, I think I can't be I can't be more in agreement with you. I think proactivity is now important to act before it impacts, meaning that you get your story together, that you have your risk management described, and also you act to it, and that you not go into only paperwork. And that's also with the value chain, that you build in the appropriate profits. And with COVID, it can be different, because that really impacts your profitability. In some businesses, and other businesses, you even get a higher profitability. That depends on the business. So go into your own industry and looking for what is in the market, what's happening. Further, I think on transparency, use your CBCR and a market file and local file for your benefit, to set your story into it, that your story is in it, your defense, and that you've analyzed it, and that can be a benefit for yourself. It's just the whole transparency, use it. And documentation is in the end what you're giving to the tax authorities. So everything what's above should be in it. And to avoid future legislation, do it also on time. Don't wait for it. This morning I had a discussion with the head of tax. Should I be proactive or just after the year making my documentation? I think you know my answer. be proactive and put your story into it, and I think that's it. Be prepared, because I think like last recession, in the recession, the tax authorities and the states were helping the companies because the economy was the most important. And after the recession, they needed money for the treasury. And it is not a coincidence that the BEPS project started around when the economy was going up a little bit again, because they needed money. Yeah? And I think that the same will happen after this recession, which maybe will not last the 7 years, which almost the recession then had as a time frame. It could be vastly more in 1 or 2 years, but be prepared. That's something which really comes together. And maybe for my final remarks, it is good that we have this discussion with each other, because India is really an emerging market, forerunner in the OECD. A lot of possibilities to get your risk management done by the APAs and MAPs. And also what is important, I think that we can discuss it with India and understand it. I think the discussion on the high markups was for me, a very good one to understand really the thinking of India in this kind of operations on transfer pricing, and that's great. And maybe as last remark, and that's, I like cultures, I like people, therefore I like to discuss this with you at India. I think it takes the culture into consideration, and that's, I think, extremely important. And the technique is one, but the process and just is, I think, vastly important as well. Get that act together.
Right. Thanks, Theo, for this. I think we can just spend another 5 minutes for quickly rounding up with the question and answers.
Would you take up some questions from your side, Akshay?
Yeah, I would, because I think these are more India related. First question: will the tax authorities ask hundreds of follow-up questions in Faceless and give arbitrary deadlines for the submissions? The answer very confidently is no, because this will not be one person really asking you questions. This will be a team of people discussing and really looking at a questionnaire and sending you those questionnaires, and you need to answer those. Very important from our side, that is the taxpayer side, is when there's a questionnaire received, we should take it seriously. And if there are 10 questions which are asked, we should answer those 10 questions rather than arbitrarily just not answering point number 9 and going ahead. So I don't think there would be very short deadlines which will be given. It will be a very computer generated process. There would be proper deadlines that need to be given. That's not the intent of law. I hope that I was able to answer that. Let's look at the next one. If I'm able to justify my cost and I'm following a cost plus method and making just 1 or 2% markup, is that okay? So first of all, we need to understand which industry do you belong to, because various industries would have different types of markup. Then we need to understand what type of transaction you have entered into. And accordingly, we need to justify what type of markups that particular transaction would command, and whether that is okay or not. But I haven't really seen any markups really as low as 1 to 2%. Okay, let's look at the next one. Is there a list of low value added services from an Indian perspective? Yes, there is a list of low value added services. This is in the safe harbor regime of India. It's given in the definition part. Is it different from the OECD guidelines? No, it is not. It's almost, I would say, 99.99%, as they say nowadays. It's very similar. That would generally include the support functions, the non-core functions, the functions which are based on not any intangibles and which are not involving any significant risk. The markup of 5% is above the salary of the employee. What overheads could be added? Now, while we are talking about a low value added services, intragroup services, this is mainly an overall cost that we are talking of. That is the full cost method. and just not the salaries. So all the salaries plus the allocated expenditure, and that is something that needs to be certified by a chartered accountant, is what the act is stating about, because the allocation ratios, the way an expense is maintained, the way you are categorizing it, needs to be seen through and audited for going for that 5% benefit. Okay, I think there is one more question, which is, how does delineation of transaction affect the TP adjustments if the transaction is disregarded by the tax authorities? I'm not able to understand this question very well. Sumer, if possibly if you can get in touch with me, I know you have my contact details, so I'll be more than happy to clarify this position one-on-one. I think there are others also, but I think we could just.
I think may I suggest for some period of time we will come back to all your questions. I think we have them here. If you we will, I think, take that on board also when we send out the presentation, that we see if there are questions to be answered, that we will take that on board and then email to you, because I'm a very question is good to be answered like that, I think, and so that we try to do this in 1 hour, 1 hour and a quarter is fine. You can listen to our webinar back again when you go to our website. You see there are more webinars are also present, and we will have some webinars coming on that they are on this list. I want to repeat it, and to be honest, the good hope that will be a nice one, because that's something that will be more about what's happening in the world on these items and not the technicalities. And let's see how that works out. And again, Akshay, for doing this, and to be honest, I liked, because you're really structured in your approach, and you're working on transfer pricing. It's great to hear, and I hope that one day the time will be that we can see each other again. So we talked about coming to India a lot, to the Netherlands the same. So I would be very pleased to do so. So because transfer pricing and working together is not only about OECD guidelines, it is also about understanding and liking to discuss with each other and to enjoy another company. And therefore, thank you for this more than an hour. It was a great pleasure from my side.
Theo, thanks a lot too. It's been a great honor and a pleasure too. It's a great pleasure working with you, and I think the relationship will only strengthen from here. I'm really passionate about transfer pricing, and I'm sure you are also. So so I think something good will always come out of it, and I'm eager to host you in India whenever you are here.
Well, and everybody heard that. Thank you. Okay.
Absolutely. You should. You should.
I know, and you know, I have somebody with me that's an art in the art business and painting. And if you come to India, I think there will be a lot of very beautiful paintings coming out of it. So thank you again. Thanks all for listening in. Hope you got out of it what you would like to get out of it. And if you have questions or to Akshay or to myself, please come forward. We will take that on board. Thank you, and bye-bye.
Thanks a lot. Bye-bye. Have a good night.